Friday's disappointing U.S. jobs report may tip the scales in favor of more QE from the Fed, which holds a two-day meeting later this week, as we mentioned. The announcement on Thursday is expected at 12:30 p.m. Eastern, followed by press conference from Chairman Ben Bernanke. During his speech at Jackson Hole last month, Bernanke set the bar for more possible bond buying, calling the stagnant job market a grave concern. And a Reuters poll conducted just after the jobs report Friday found 60% of economists now believe the Fed will launch so-called QE3 this week. So will they or won't they? Joining us now is Lance Roberts, CEO and Chief Economist at Street Talk Advisors. Lance, good morning, and thanks for getting up for us this morning. And I'm just curious what your own view is now as to whether we're going to see QE3 come Thursday.
Well, you know, I've been talking about this for, I guess, really like the last 3 months, saying that we're not going to get more balance sheet expansion programs at this time. And we haven't gotten any yet. And the reason is simply because the markets are already up for the years and near their highs. And the issue is that the purpose of balance sheet expansions in particular is to boost asset prices to increase consumer confidence. So expanding balance sheets at this point, with the markets already up 13% for the year, there's really not a lot of quote-unquote bang for the buck for Bernanke to get out of an operation here. And they're very costly because increasing balance sheets not only increase consumer inflation, which we've already got a consumer that's really kind of struggling to make ends meet, and really kind of goes back to the credit numbers we're going to see this afternoon. But more importantly, interest rates are already near their lows. And last time you and I spoke, Kelly, we were talking about a 1% yield on the 10-year.
Right. The argument, though, is that this is really about the Fed. And we hear this from the ECB, the same thing, removing kind of the tail risk, i.e., if they weren't to act, that the U.S. economy could potentially worsen, that, you know, that equity prices, that asset prices would do much worse. Does that argument hold water?
Not really, not so much. And there's also a bigger issue is that, you know, what Ben Bernanke said at the last meeting is that he will provide accommodative action as needed. And he said that the last 3 meetings. That is not new language. And accommodative action doesn't necessarily mean LSAPs, which are the QE type programs. Could be just extending the low interest rate environment until 2015, could be a variety of other issues. But, you know, at this point, yes, stock markets could do a little bit worse if he doesn't announce QE at this meeting. But the issue is, you've got to think about this from Bernanke's standpoint. He's getting less and less return for each program, and he's talked about these diminished returns on each of the programs that he's done so far. And with the economy not completely sliding off a cliff at this point, with the markets doing very well for this year, interest rates already low, he really should be looking at saying, you know, I'm going to hold off on this ammunition until I really need it. If the economy is close to recession or having another systemic event out of Europe, which is a likely case in the next 3 or 4 months, I would expect QE at that point, maybe later this year, first part of 2013.
Okay, Lance, so no QE then. So how does the recovery, if we can call it that, go without QE? Do we continue to see what's often been referred to as a jobless recovery?
Well, that's what we've been seeing for the last 3 years. So I'm not sure anything's really going to be fundamentally different at this point. I mean, if you look at employment, it's remained weak. And let's talk about QE and its effect on employment. Really hasn't been one. There's not a really good direct correlation between QE programs, these balance sheet expansion programs, and increasing jobs. You know, what increases jobs is the type of fiscal policy that Ben Bernanke has asked Congress for at the last 5 meetings from the FOMC. He keeps saying, I need help from Congress. I need fiscal policy. I need deregulation. I need taxes established. I need something dealt with on the fiscal front, because that's what's keeping jobs from being created. It's not QE. If you ask businesses, why are you not hiring? They don't say, well, it's because we don't have a QE program. It's because poor sales is their #1 concern. Look at earnings this last quarter. Revenues are down sharply. Earnings are down sharply. That's not the type of environment that you want to be hiring employees into, which are very, very costly.
And Lance, we're actually going to get into several of those issues on the fiscal front in just a little bit. Lance Roberts will stay with us. Welcome back to the program. Well, it was the payrolls report heard around the world. And just a reminder, in case you somehow missed it on Friday, shame on you. No, I'm kidding. But August payrolls did increase by 96,000. This was well below expectations, which were running somewhere in the range of 140,000 jobs after a strong reading on private sector payrolls earlier in the week. The July payroll figures and earlier reports were also revised lower. The August jobless rate did fall. It fell to 8.1%. That, though, was partly because of fewer people in the labor force. Lance, curious what your own read on that was. You know, earlier we were talking about what it meant for the Federal Reserve, but just on its own merit, was this a disappointing report?
Well, yes. and really what was really disappointing about the number itself was really what was behind the number. Over 500,000 people moving off the rolls entirely into the not in labor force counted category. The number of people that are basically moving on to some form of welfare or some type of support from the government. You know, record increase now in the number of people on food stamps. Just in the last 3 years, more than almost 15 million people have moved onto the food stamps. That, you know, it really tells you a lot about the structural dynamic of the employment here in the United States. And what you're seeing here, too, is still an increase in the number of people that are being hired for temporary work rather than full-time employment. And, you know, and a lot of the full-time jobs are in the lower paying wage range, which it really impacts the consumer for down the road for stronger economic recoveries.
Well, John McCain thinks we have a good chance of coming together. Lance Roberts is still with us. Lance, do you agree? Do you expect some sort of action to avert what we're potentially facing in terms of a fiscal contraction come January 1st?
Well, isn't that the $64 million question, as they say? You know, what concerns me here is that we kind of have the same setup that we had last year. You know, remember last year when we were talking about the debt ceiling and whether we need to raise it, which, oh, by the way, we're at the debt ceiling once again. You know, what the potentially concerning part is everybody knows we need to do something. I don't think there's any question about that. What concerns me, though, is the possibility that between the right and the left, that we get into one of these other, you know, one of these kind of debt ceiling showdowns over the fiscal cliff, and nothing gets done in a timely manner, and that does spook the market. And I think that is a real risk going into the end of the year.